Okay. Okay, so let's go ahead.
So had it not been
You-
this, you teach it again. Like after that, you don't recall, like you call for another class on the same stuff, then teachers.
So you should know this formula. Now, when they ask you to calculate it in revenue, you just change the contribution per unit to CS ratio, or you multiply the break-even points in units you have times the selling price. Now, the next thing is with the margin of safety. The margin of safety, you can calculate it in units, percentage, and revenue. If it is in units, then it simply becomes the budgeted units minus the break-even point in units. If you are asked to do it in revenue, just multiply the margin of safety you've gotten in units times the selling price. And if you want it in percentage, just take the margin of safety in units over the budgeted units times 100. So now when you want number of units for a before tax profit, you just add the profit over contribution per unit. If you want it in revenue, you just change the contribution per unit to CS ratio. The same way if you need a profit after tax, that one add the profit, but then divide it by the tax factor over contribution per unit. When you want to change it to revenue, remove the contribution per unit and put a CS ratio. Then degree of operating leverage. So it should be easy for you to memorize. So those are the 10 formulas. Have you written down all 10 formulas?
Yes, sir.
Yes. Yes.
So
Last one.
Yes, ma'am.
are we okay?
Yes.
Then now let's look at the question. Biotex Limited. It says that the following information relates to Biotex Limited for the forthcoming period. We replied, determine I the profit for the period, I degree of operating leverage, and then that kind of thing. So first prepare a budgeted profit statement. Say Biotex Limited, budgeted profit for the period. So we have revenue. Yes, what's the selling price?
150 cedi.
50,000.
So 150 per unit
By
by how many units?
10,000.
10,000 units. Give me what? 1,500,000, right?
Yes.
Then variable cost is a decision-making situation. So always write your statements in marginal costing approach. So variable cost, okay, the per unit is what?
60 cedi.
So yes, variable cost. You said per unit is 60. So let me take the 60 out. When I multiply by 10,000, giving us what 600,000, right?
Yes.
So when I take it out, the contribution. So you see, I'm working it in per unit and total at the same time because I need the contribution per unit. Are you getting it?
Yes.
Yes.
So it's 90 per unit, giving me 900,000.
100,000.
And now less the fixed cost from it. Where the fixed cost? Production and administration. Okay. So fixed cost at production is how much? 200,000.
Mm.
Then at selling and admin,
160.
160 coin.
That gives you 360,000.
36.
What's the budgeted profit?
540.
So this is a budgeted profit of 540,000. Now you just apply the formula. Degree of operating leverage.
First cost
Cost
over
over
contribution times 100%.
contribution times 100.
Yeah, so if I say fixed cost over contribution, what was the fixed cost?
200,000.
Over. What was the contribution? 900,000,
100,000.
Yes, sir.
The first, okay.
Contribution is 900,000. Then times 100.
Yes, sir.
What percentage is it giving?
40%.
40.
Now, what this means is that fixed cost, it means that fixed cost accounts for, or it consumes only 40% of contribution. So you see, if fixed cost is only 40% of our contribution, it means you can pay the fixed cost and even have more. Are you getting it?
Yes.
So the company, there's the operating capacity. So the operating capacity of the entity is strong, exactly.
Yes, sir.
Means, like in financial reporting, you will see the company is not highly geared. Are you getting it?
Yes.
Yeah, because 60% is about profit.
Yes. So it's not highly geared, but in operating terms, we say it has a strong operating capacity. Are you getting it?
Yes, sir.
Then break-even point in units and in sales revenue. So I. Break-even points in units. So break-even points in units. Yes, what is the formula?
First cost over contribution.
Contribution per unit. First cost over contribution per unit. So that will give us 360,000. The contribution per unit is what, 90 per unit, right?
Yes, sir.
Yeah.
And now you are 4,000 units. So that's 4,000 units, eh?
Yes, sir.
Yes.
Then we want it in sales revenue too. So in sales revenue, so if you want it in sales revenue, like I said, we can either take the break-even point in units
Well,
multiplied by the
times
selling price.
selling price.
In that case, we'll have 4,000 units times the selling price of what? 150, eh?
Yes.
Which will be what? 600,000. So either this or you can use the formula, the same formula, and then you take out the contribution reduced by CS ratio. Or you can do the fixed cost over what? CS
Ratio.
ratio. So the fixed cost is 360,000 over CS ratio means contribution per unit of 90 over selling price of 150. Are you getting it?
Yes.
So when you calculate, it will still give you the 600,000. Are we following?
Yes, sir.
Yes.
CVP is easier. Oh, you just have to be strategic. Now I say the units to produce and sell to make a profit before tax of half of fixed cost. So let's look for the target profit first. So IV, you first look for the target profit. Now the target profit, they say it is what? Half of what? Fixed cost.
Fixed cost.
So when you calculate that, that will give you half of what?
360,000.
160,000.
Giving you what?
180. 180,000.
180,000. Now the question is asking for the number of units that will make this tax to make the profit of 180,000. How many units must we sell to make the profit of 180,000? Then that becomes what? The fixed cost
Fixed cost plus target
plus the
profit.
target profit
Over your
Over
contribution.
contribution.
is over contribution per unit, not total contribution.
Yeah.
Contribution per unit. And so that is going to give us fixed cost of 360,000
Plus
plus the target
180,000.
profit of 180,000. Then contribution per unit is what? 90 per unit.
90,000.
So with your calculator, 540 divided
6,000.
by 90 is about 6,000.
Yeah.
So that's what 6,000 units.
Units.
Yes.
That's 6,000 units. If tax is at 20%, so we at 20% tax, yes, so we should make a profit after tax of 180,000. So 1 minus T will be equal to what? 1 minus 0.2, which will give you 0.8. Is that clear?
Yeah.
So the number of units to sell to make corporation tax of what? 180,000. We say number of units to make a profit after tax of 180,000. So we say what? The fixed cost plus the target profit. This time there is a tax. So the target profit divided by the tax factor, right?
Yes.
Hold this before you divide it by what?
Okay.
Contribution per unit. Are we following?
Yes,
Yes,
sir.
Yes.
sir.
So what is our fixed cost? 360,000 plus 180,000
Over.
divided by 0.8, right?
Yes,
Yes,
sir.
sir.
Yes.
All over 90.
All over the 90 per unit. So calculate that.
Six 500.
1,500.
6,000.
500 units.
Are you getting it? Now they say we should determine the margin of safety in units and in percentage. In units and in percentage. So VI. Margin of safety.
It's 7,500. It's
A.
500.
A. A.
6,500.
6,500.
Your calculator is worrying you, change it to. So margin of safety is what? Budgeted units. And of the break-even points in units. So that gives you what? The budgeted units was what? 10,000 units.
10,000.
And then the break-even points in units, we got 4,000, eh?
Yeah.
Giving you 6,000 units. That's it. And in percentage. So if you want the margin of safety in percentage,
Divided.
if you want it in percentage, you just take the margin of safety in units, take the margin of safety in units, and divide it by the budgeted units.
Times 100.
Then you multiply by what? 100. Then you multiply by 100.
Sir,
Yes.
so the examiner has an option of asking you to express it in percentage or in whatever decimal
Yes.
he likes.
Yes. Yes. So what did you get? 6,000, right?
6,000 over 10,000.
Yes.
Then by 100. Giving you what? 60.
60%.
60%.
Why is this 60%? Because you can see that our fixed cost swallowed
cost
only
was
40% of our
40%.
contribution, right?
Yeah.
It means that we have a safe zone to operate within 60%. Are you getting it?
Yes.
Yes, sir.
Good. So within 60% of capacity, when we operate, we'll be making profit. If you go beyond that, it will start making losses. They said, assuming in the coming year, marginal cost per unit is expected to increase by 40%. So B, in the coming year, they said assuming marginal cost per unit will do what? Will increase by 40%, right? It means that now the new variable cost per unit, so it should increase by 40%. That means 140% of the old one, right?
Yeah.
The old variable cost. What is the old variable cost per unit? The old variable cost per unit was what? It was 60, eh?
Yes.
Or 60.
Yes.
So that gives you what? 84, right?
Yes, sir.
Yeah,
So
84.
the new variable cost per unit is 84. And they said fixed cost will also increase by what? 20,000. So the new fixed cost will also be equal to what? The old fixed cost was what? 360,000.
360,000.
Now they say we should increase by what? 200,000.
560. 560.
560,000. So this is the situation. What will be the sales in value and in units in order to make a before tax profit of what? 180,000, assuming selling price remains constant. So it means that at that point, our contribution per unit will what? the selling price, they say it should still be what, 150 minus the variable cost per unit. Now our variable cost is what, 84, right?
Yes, sir.
So that will give you what?
$66.
56.
Now they say how many units must be sold in order to make a before tax profit of 180,000. So they say the number of units to make a before tax profit without the fixed cost plus what? The target
Target
profit
profits. The contribution per unit.
over the contribution per unit. Over the contribution per unit. So now our new fixed cost is what? 560,000, right?
Yes.
Yes, sir.
Plus the target profit of 180,000. Now the new contribution per unit is what? 66, eh?
66.
So calculate that for us. Yes.
One, 203.
212.
11 300. Okay.
200.
So it means they will now have to put they will now have to budget more and expand production. Produce the into one to so that's the game. So that's the game. They say in value and in units. So that is in units. If you want it in value, in revenue, if you want it in revenue, we say what? Fixed cost plus the target profit. We say the fixed cost plus the target profit over what?
Yes.
Yes,
ratio.
ratio.
And so that is what? 560,000 plus 180,000 over CS ratio is 90 over what? 150. Eh? Okay, the contribution is now, what's the contribution now?
56.
6.
It's now this
This is
plus the target profit of 180,000. Now contribution is now 66, selling price is 150, right?
Yes.
So calculate that for us. What are they giving?
Hundred
1850.
91.
One what?
1850,000.
You are mentioning different answers.
1,681,818. 681
818.
818.
So you can either do it this way or you can take the target units. You can take the target units that you must sell to get that profit and multiply by the selling price. So in that case, we said they should sell 11,212 units, right? At the selling price of 150. So do that and see.
168.
168, 800. Wait, 800.
It's the decimal that's causing the difference. So
Yeah, because with this one there was some points, something units.
800.
that's it. So that is that. So the second question, BB Company Limited, determine the budgeted profit, the degree of operating level, break-even point in units and sales revenue. What is the sales in Ghana cedis and in units? That will make a before tax of 120% of fixed cost. If the tax rate is 30%, how many units must be sold? So you can do this. It's the same thing, right?
Yes.
Yes, yes.
There is a proposal. There is a proposal which involves producing an additional 5,000 units in addition to the budget. The marginal costs are expected to increase by 60%, and the selling price is expected to increase by 40%. Additional marketing cost of 4,000 is to be incurred. So this one is a special order, is that clear?
Yes.
What it means is that, let me solve that B part for you and see. The BB Limited, I'm solving only the B part, the special order proposal. Look, if you look at it, the question here, the special order, they are saying that additional 5,000, the marginal cost is expected to increase by what, 60%. So the new variable cost per unit is going to be what? It says to increase by what? 60%. So it should be 160% of the old one. Are you following?
Understand?
Yes.
Now the old variable cost is direct material plus direct labor plus variable overhead. So that would be what?
That would be 6.
2.2 plus what?
2.8 plus 1.
So that's 160% of 6.
That's
So
that would be 9.6.
that's 9.6 per unit. We need the new variable cost, right?
Yes, sir.
So once you have a new variable cost, yes, what are you going to do? So you assess that order. You know the decision rule for special order. If it makes contribution, you have to assess. You have to accept, right?
Yes, sir.
Yes.
Assessing to assess the special order. So how many units is that? 5,000 units, eh?
Yeah.
So the revenue for that, they said the selling price will be what? Increased by 40%. So
Yes,
140%.
140%.
140% of 10 cedis, right?
Yes.
Yes, sir.
Times the 5,000 units. What is that giving you?
70,000.
70,000. Now the variable cost.
That would be 9.6 times.
You have 9.6.
By 5.
Giving you what?
48,000.
48,000.
38,000. Now there is an incremental fixed cost. There's an additional marketing cost of 4,000. So there is an incremental fixed cost. Is that clear?
Yes, sir.
You know, incremental fixed cost is relevant, right?
Yes, sir.
Yes.
I think you all understand what we are doing.
Yes, sir.
Yes.
Yes, sir.
So is there any contribution? Is there any contribution? Is it giving you contribution?
Yes, sir. 18,000.
So then you conclude that the decision will be that management must accept the special order. Management should accept the special order since management will accept the special order since it will generate contribution of 18,000.
Sir,
So
can
if
you throw light? Can you throw light on the solutions more for me?
they've said there is a proposal that involves additional 5,000 units in addition to the budget. So somebody is giving you a contract to produce an additional 5,000 units. They are asking you that what will be management's decision. They are asking you that should assess the proposal and advise management whether or not to accept the proposal. So this is a special order. Special order, what is the decision rule? You must compare the revenue from the order to the relevant cost, whether it will give contribution. Are you getting it? Are you getting it?
Yes, sir. I'm with you.
So when you compare the revenue from the order, they said the selling price will increase by 40%. So that will be 140% of the old selling price times the number of units 5,000, 70,000. Then the relevant cost there will be the variable cost. So the new variable cost is 9.6. And then there is an incremental fixed cost. They said additional marketing cost of 4,000. That's an incremental fixed cost, 4,000. It will generate an extra contribution. Are you getting it? My brother, are you okay?
I'm okay, sir. I'm okay.
So if management should accept it, yes. What are some of the qualitative factors? Somebody should tell me what will be some of the qualitative factors. Yeah, what are some of the qualitative factors to be considered?
Availability of raw materials.
Yes. So what qualitative factors? Because now you are going to produce extra 5,000 on your budget. So is the raw materials available? Yes. So
the labor availability of labor or human resource.
Remember, labor is already there. You are paying them. You are not producing up to 100% capacity.
Possible breakdown of machines.
Exactly. Possible breakdown of machines. So you have to do regular maintenance. Exactly. Hey, this is our network.
Yeah.
There's possible breakdown of machinery. There's possible breakdown of machinery. So when you know this, then you have to do regular maintenance. Then what else again?
Efficiency of the
Efficiency of the existing labor.
Efficiency of the existing labor. Yes. Whether they will start showing lukewarm. You know, some labor, they are there. You are paying them all right, and they are working below the production target. But the moment you increase production and first, because they were working below capacity, maybe you used to close them at 3 o'clock. Now that there's an extra work and you are now closing them at 4 o'clock, they will start showing lukewarm attitude. You know that?
Yes.
So that's the nature of human beings. When they were high, they were supposed to close at 5 o'clock. But because we are producing below capacity, sometimes you even close them at 3. Now that a contract has come and you say they should stay up to 4, then they start showing attitude. So these are some of the things you need to consider.
What about
Then they
quality?
say
Can you say quality of the products?
the efficiency of the labor that will determine the quality. Are you getting it?
Okay.
Then what will be the sales in value and in units in order to maintain a before tax profit of 85,000? So you know that fixed cost plus the target profits over what? Contribution per unit. So now since they give you a new selling price and a new variable cost, you will get a new contribution per unit. Is that clear?
Mhm.
And then additional marketing costs has also come. So you also get a new fixed cost. Can you picture what I'm talking about?
Yes.
Yes.
Let me hint you here. What I mean is that now you will get a new fixed cost. Nah.
Mm.
So the new fixed cost, what's the the old fixed cost? From the question, what's the old fixed cost? It was 60,000, right? 40 plus 20, right?
Yes.
60,000. Now they say we will incur additional marketing costs. So we incur additional marketing cost of what? 4,000. Can you see?
Yes,
Yeah.
sir.
65.
So that's 64,000, right?
Yes.
Then contribution per unit. You also get a new contribution per unit. New contribution per unit. Yes, we have a new selling price, 140% of 10. 140% of 10 became 14 cedis, eh?
Yes, sir.
Remember, they said it will increase by what?
40%.
By 40%.
40%.
Now, the new selling price is 140% of the old 110 cedis. And that will give you 14 cedis, exactly.
Yes.
Yes, sir.
Then the new variable cost per unit. The new variable cost per unit up there, we did it here.
6. 9.6.
9.6, right?
Yes.
9.6. So put it in there. So put a 9.6 in there. So it means that the new contribution per unit will give you what?
4.4.
4.4.
4.4 per unit. So this is a new contribution per unit. So if the question is saying what will be the sales in value and in units, we will say the sales units to make a before tax profit of 85,000 to make a before tax profit of 85,000. Yes, since we are looking for a before tax profit, what must we do?
Let's find out fixed cost.
What should the formula be?
Fixed cost plus.
Yes, plus the target profits.
Oh, so this measure can never be smooth. So that will give us the fixed cost plus the target profit.
The target profit over
Our contribution per unit.
yes, sir.
So now the new fixed cost became what? 64,000, right?
Yes, sir.
Yes.
And then the target profit is 85,000.
85,000.
The new contribution per unit gives us 4.4, right?
4.4.
So 4.4 per unit. When you calculate how many units are you getting?
33864.
33.
864.
So that is it. But they are asking us for it in value too. They are asking us in value. So in revenue terms, yes, in revenue terms, if we want it in revenue, what will we do?
It will be your FC plus your target profit over your CS ratio.
Yes, for sure.
We are now flowing with it. So the same thing, 64,000 plus the target profit of 85,000. CS ratio contribution was 4.4. Selling price was 14, right?
14.
Yes, sir.
Yes.
Giving what?
64 plus 85,000.
474091.
47.
4091.
Like this. Oh.
Yes. It was 90.9, so I just ran it.
That's true.
Okay, that's fine. So that is that. That is that. So you go and do the normal one. I think I'll solve the B part for you. Is that right?
Yes, sir.
Yes.
Okay. Let me see that there's a multiple product CVP and let's deal with that. Yes, look at November 2017, Zuma Limited. It's a multiple product CVP. November 2017, Zuma Limited. Continue from November 2017, Zuma Limited. Are you okay?
Yes, sir.
The multiple product CVP. Now, when there are multiple products, this is what you must first do. You must first determine the sales mix. Whenever there are several products, this is what you do. You first determine the sales mix. When we say the sales mix, is the proportion in which the goods are sold.
Yeah.
Proportion in which the goods are sold. You determine the proportion in which the goods are sold. Then once you do that, you calculate contribution per unit for all. Calculate contribution per unit for all. When you calculate contribution per unit, then you calculate weighted average contribution per unit. You weight it by the sales mix. So weighted average contribution per unit. Oh, it's my network. You calculate the weighted average contribution per unit. Once you do that, now your break-even point in units. Now your break-even point in units is simply going to be the fixed cost. Now, instead of contribution per unit, you say weighted average contribution per unit. Exactly. Now you use the
Yes.
weighted because there are multiple products. Now, instead of using single contribution per unit, you use the weighted average. You use the weighted average. Can we move on?
Yes, sir.
Yes.
Sorry, sir. Go.
So look at Zuma. He said, Zuma Limited manufactures and sells two complementary products, Hyaline and Glycerin, in the ratio 3:2. The result for the just ended period showed the following. So joint fixed costs of 180,000 are apportioned to the number of units of each product sold. The company is in the process of preparing the budget for the coming year, and it is desirous of improving the performance of Glycerin. Therefore, the following proposals are being considered for implementation. You should increase the price of Glycerin by 25% in expectation that the quantity demanded will reduce by 10%. Read through the production process, which will result in a reduction of joint fixed cost by 15% and an increase in variable cost of each product by 10%. Then 3, introduce proposals 1 and 2. A says you should determine the units of products to be sold and hence prepare the profit statement for the just ended period. Okay, you know what? Because this is multiple product CVP, let's finish the single product first before we come to the multiple product. So look at the question after it, the May 2019 question. Look at the May 2019 question, both Siakun Limited. I want you to see something there. It's a single product CVP, but there's a trick in it. So look at it first. May 2019. The next question after Zuma. Have you seen it?
Yes.
Yes, sir.
Yes. Yes.
Now look at this, if you can identify the trick in the question. Siakun Limited manufactures high quality coffee biscuits that are sold to hotels and restaurants in Koforidua. 2 months ago, it had prepared a budget for the forthcoming year. And these are the details of the budget. The budget above has been prepared on the assumption that the sales will be 800,000 packets of biscuits. However, due to changing economic conditions, the sales forecast for the year is now 720,000 packets of biscuits. It is expected that selling price per unit, direct cost, and variable overhead cost will not change from those budgeted. It is also expected that fixed costs will also be the same as those budgeted. Now, management is considering the number of options to improve profitability. And they're giving you 3 options as follows: option 1, option 2, option 3. A, you are to calculate the expected profit for the current year. Then B, based on the profit, calculate break-even points in units, the margin of safety in percentage, the sales required to earn a profit of this. Evaluate the profitability of the 3 options, blah, blah, blah. 15 cool marks. So they said, we should calculate the expected profit for the current year. So what trick do you see in the question? Calculate the expected profit for the current year. What trick do you see in the question? They've told you that the budget that has been presented above was on the assumption that we're going to sell 800,000 units. Is that clear?
Yes, sir.
But now, due to changing conditions, the budget has now become 720,000 units. It means that you cannot use these figures for the budget again. You have to flex the budget. True or false?
Yeah. Yes, sir.
True.
You have to flex the budget before you do the CVP. So students went to the exam hall that morning. They bathed and dressed neatly. After they went to sit down, they saw the question and they thought, oh my God, at least for the first time, my trouble in management accounting has ended. 15 cool marks. They did not read well to see that there have been a change in budget. Therefore, the budget should be flexed. Then they started putting down their formula, working the CVP nicely in anticipation of getting 15 free marks. Little did they know. They only realized they have made a mistake. At that time, the papers have gotten to East Legon. So you see some of the things you do in exams. When you see the question and you are in a hurry to get the marks, read well and find out the hidden issues. ICA is not just sharing free marks. That they know CVP is the easiest among all the decision-making techniques. Then they'll just throw a raw question for you. They'll put down something small, some small spices to make the thing interesting. Is that clear?
Yes, sir.
So you have to open your eyes. Are we listening carefully?
Yes,
Yes,
sir.
sir.
ICA will not throw a walkover question. No. So when you read the question and you see that, oh, this one CVP or limiting factor is easy, take your time and read for the condition. This is a situation where you saw the limiting factor in free zones, that they added small condition that we have to produce a minimum of 3,000 and it threw people off. So you need to be careful. Whilst I'm doing that, I have taken note of a lot of people who have gone back into hibernation. So let me quickly do my roll call. Benedicta, Joseph, Daniel, Emmanuel Sari, Erika Nani, Esther Naameli Hammond, Galaxy A17, Hayford Dankwa, iPhone, Lauren, Ranting, Michael Yimpusa. I want to see you people unmute yourself. They are still not unmuting. They are sleeping. Benedicta, Bukwe Joseph, Daniel Adipa, Eric Anani. If they are still not unmuting, it means they are sleeping. As for the early morning class, some people will join and then they will be sleeping. If you are sleeping, then what is the essence of it? Put on your microphones. Let me hear you. Yara, Phil, Patrick, Phil, you are always on Phil. I've taken note of every day you have yourself. What's the problem? Now Amelia Hammond, Esther.
Yeah, hello, sir.
Yes, so your response alone shows that we are not concentrating here.
Oh.
Your response shows that you were doing something else, so you responded in shock. Please focus. Watching videos is not the same as getting the direct explanation. So focus and ask questions. ICA will not throw a walkover question. Hey, you want to write management accounting paper and be smiling and rejoicing behind the paper, then it's not ICA exams. The marks should be earned on merit. So even if you pass, it must be that when you finish writing, every single day, you continue thinking your BP will rise until the results will come. When the results come, is good, then the BP will come down. You cannot have a silver platter like that. There must be casualties. So they will not give you a walkover question. Therefore, when you see easy questions And on the face of the paper, you see it as easy. Take your time and read the theories attached to it. That's where the conditions are. Read the conditions and be sure of what you are supposed to do before you touch it. So in both Siakun Limited in May 2019, the question was a fairly easier one. But the trick in there was that, yes, they are telling you the budget there was for 800,000 units. And now you are producing 720,000 units. So you need to flex the budget. So May 2019, go with Siakun Limited. Okay. So if we need to prepare the budget for the 720,000, we need to flex the budget first. So the selling price per unit, the selling price per unit, when it was 800,000, there will be 6 million divided by
quantity.
800,000. So what will the selling price be? What will the selling price be?
7.5.
Will be 7.5.
7.5 per unit. Yes. Then direct materials per unit.
It will be 208.
We are going to flex the budget. So calculate all in per unit. This network issue is very, very frustrating. So the direct materials per unit, what's the direct material cost?
8,000.
Divided by the 800,000 units.
Which will be 2.6.
2.6.
Direct labor 1160 over 800,000.
Per unit. Do the same for labor.
1.45.
So calculate ahead for me. Do the same for labor.
1.45.
Variable overheads 840 800,000.
Mm-hmm.
1.0.
The direct labor is 1.45.
Overhead is 1.05.
1.05.
So the overhead is what? 840,000.
Over 800,000.
800,000. 1.05.
Per unit, eh?
Yes, sir.
Yes.
Shit.
So the fixed overhead remains the same.
Sure.
So now let's prepare the budget for the 750,000. So you title Igbo Isiakun Limited. Igbo Isiakun Limited. Yes, budgeted profit for the current period. The revenue very bad network, very bad network. So what's the selling price? What's the selling price now? 7.5
7.5 by 720.
By 720,000. Giving you what?
5.4 million.
5.54 million.
Is it 5.4 million or 54 million?
5.4.
5.4. That's it.
Okay, so then variable cost. So material.
86. Divided by 720.
No, material, we have it already, but we've done them here.
Yeah.
26.
So
2.6. Oh.
2.6 by
2.6 by
720, which is 1,008,000.
One what?
1872. That is
1872.
1,872,000.
What about labor?
Labor is 1.4 by
1.45.
by 720. 1,044,000.
1,044,000. Let me go up. Yes, then variable overhead.
1.05.
1.05.
1.05.
Yeah, by 720. 756,000.
256,000.
You can see what I write. It's very frustrating. What are you getting?
756,000.
756,000.
756,000.
Yes, please.
Yes.
So sum all the variable cost.
670.
What are you getting for the total variable cost? Sum the per unit and the total, or sum both the per unit and the total.
3672. Okay, so the total is 3,670,000. It's 3672.
There is that 3 million what?
672,000.
Okay, so quickly get a contribution.
That's 7 to 8,000.
So the contribution, give me the per unit first. No, right, and it doesn't come out clearly. Those who watch, and that this is going to public, so I'm very careful.
2.4.
2.4.
So this is 2.4 per unit. And then the total is doing as what?
1728.
1728 what?
Thousand.
Okay. So now we can less the fixed cost on it. The fixed cost.
Fixed
970.
cost is 9. Yes, sir.
So what's the budgeted profit then?
756.
400.
75.
6.
400.
Oh, sorry. 400.
So we have this.
The fixed
Now
cost are 600. 972, 600.
So it will be 755. So 755.
400.
Goes 972 600. So then the profit becomes what?
755. 400.
So what's the total profit there?
755 400.
755 400.
Yes.
The network has slow, let's down this network thing. Okay. Okay, so now what is the question asking us to calculate? Now, from the question, is how we should calculate the profit based on the profit, calculate the break-even point in packets of biscuits. So break-even point in units. Yes, let's do that quickly.
So FC over our contribution per unit.
So that's what fixed cost over what?
Contribution per unit.
So what is the fixed cost?
972,600.
972,600.
Contribution per unit give us what?
972,600.
Contribution per unit give us what?
5.1.
2.4.
2.4. Yeah. 2.4. 250 per unit.
So what is it giving you?
405.
250.
250
per unit.
It's units.
units.
Okay. So the break-even point in packets of biscuits, and then the margin of safety in percentage. So let's look for the margin of safety in percentage. Margin of safety in percentage.
Our budgeted units minus our break-even point units.
Exactly. You can see you are now understanding the issues. Yes. So in percentage, that was the
Budgeted units minus break-even point.
units,
Yes, sir.
But the budgeted.
So is it in units or okay? So if it is in percentage, then we need to okay. Sorry.
Yeah, you need to convert it to 100. Everything in percentage means
Yes.
18 over the original times 100. So
Sure.
the network is slow. Let's be a bit patient. Yeah, so what are we getting? The budgeted units was what? 720,000, eh?
Yes. Minus our 405, 250. Times 100.
What is it giving you?
44%.
Exactly 44.
No, 43.7.
43.72%.
43.7.
2%.
God bless our homeland, Ghana. 43.72%.
Yes.
Okay, so that is it. Then it asks you for what? The sales revenue to required to earn a profit of 1,440,000. Yes, so work that ahead.
Target profit.
Excuse me, the board is corrupt. Let me reshare. All right, so let's go. Yes, he said what? The sales revenue required to earn a profit of 1,440,000, right? So
Yes,
let's
sir.
see. The sales revenue to earn a profit of what? 1,440,000, right?
Yes, sir.
Fixed cost plus the target profit. All over what?
All over CS ratio.
CS ratio. Yeah, so what is the fixed cost?
9,726,600.
Plus the target profit of 1,440.
All
over. Contribution per unit give you what?
2.4.
What?
2.4.
The contribution?
Per unit.
Yes, sir. 2.4.
Yeah. Selling price of what? 7.5.
Yes, sir.
Right.
What is that?
7539375.
Okay, please confirm for me.
Yes. 7539375.
Yes, correct.
753
9375.
93375.
753 9375.
Yes.
So that's the revenue. What else is it asking for? Evaluate the profitability of the three options. Okay. So let's look at C. Yes, option 1. Option 1, what did they ask us to do? Option 1, it says what? Decrease the selling price by 20%. It anticipated that this will increase sales volume by 20%. So it means that option 1, the selling price will be, we are decreasing it by 20%. So that will be 80% of the 7.5. Is that clear?
Yes, sir.
Yeah.
Now, anytime you see questions like this, normally they do that a lot in CVP. They will give you options of profitability. Work out your figures before you draw you prepare the statement. Is that clear?
Okay.
Make sure you work out your figures first before you prepare the statement. Yes, give me 80% of 7.5.
6.
6.
That's 6 units. In anticipating that sales volume will increase by 25%. So the number of units
125%. by 720,000.
That's 125% of
Times 7,
7.
900,000.
If you give me 900,000 units,
Yes,
are
sir.
you following?
Yes.
900,000 units. Is that all?
Yes, sir.
Is that all?
Yes, for option 1.
Yeah, that is for option 1.
Then we go to option 2.
Decrease all variable cost by 10%.
Option 2. So we should decrease all variable costs by 10%.
10%
So
and decrease fixed cost.
yes. So the variable cost per unit will give you what? What was our variable cost per unit in the other question?
5.1.
So we should decrease it by what?
10%,
10%.
90%.
So 4.59.
5.1. What do you
3.69.
3 points?
Sorry.
4.59.
4.59.
4.59.
It is anticipated that this will increase sales by 25%. So number of units, if it increased by 25%, it was the same to 900,000.
Yes, sir.
Yes. Okay,
Then
so that's all.
decrease fixed cost.
Decrease the fixed cost. This is not expected to have any.
No, the
No,
option 2, there was
option 2.
Option 2, there's a mistake.
Yeah,
I was reading the option 1 instead.
It said this is not expected to have any impact on the sales level.
Decrease fixed cost by 10%.
And then that you decrease what? Fixed cost by 10%.
Fixed cost by 10%.
What was the old fixed cost?
972,600.
972,600.
Yes.
875,340.
875,340. 75,340.
875,340.
Eight, 7, 5.
740.
740.
Sales will still be maintained.
Then option 3.
It says decrease the selling price by 10%.
Decrease selling price by 10%.
Yes, sir.
It's 875,340, not 740.
Eight, 7, 5.
340.
6.75.
Option 3. Decrease all variable cost by 10%. So variable cost per unit.
No, it's the selling price.
Selling price.
What?
It says decrease the selling price by 10%.
Still reading option 2. My eyes is still on option 2.
Fixed costs is 95%. by 97 to 600.
Okay, so the selling price we are decreasing it by what? 10%.
10%.
So 90,
7.5.
6.75.
Give me what? 6 points.
7.5.
7.5.
It says we should decrease the fixed cost by 5%.
Increase sales volume by 24. Decrease fixed cost by 5%. So fixed cost
Will be 95% of 97 to 600. That will be
923
970.
970.
And then this will increase sales volume by 25%. Eh?
So 125% by 720,000.
$900,000.
Okay.
So 900,000 units. Eh?
Yes.
Right?
Yes.
Okay. So we use this information you have to evaluate the profitability. So now we say where is Sako Limited? Okay. So now, if you are evaluating various options to choose which one is good for you, do you ignore your own budget?
No, sir.
You don't have to
No.
ignore your own budget because it's possible when you check, or even your own budget to be better than it. Exactly.
Yes.
Yeah.
So you put down your current, then your option one, then your option two, and then your option three. So the revenue, yes, the current option, the current one we did, the revenue was what?
5,400.
5,400.
5.4 million.
Yes,
So
sir.
you current one,
Yes, sir.
5.4 million. Then the variable cost was how much? Take the per unit and multiply by the number of units. The variable cost is 5 point something.
So 5.2, 5.1 by 720. That one was 3,670.
7,000.
We had 3,670.
Variable cost is 5.1. So multiply is 3,672,000. Are you have it here?
Yeah, so you mentioned this.
Come on, let me write this thing. Let's take our time. People will be watching. So please pick your figures from here first before we go. 3,672,000. And fixed cost is 972,600. Exactly.
Yeah.
Okay, so the variable cost was what? 3 what?
672,000.
Please, the figure realistically. Mention the figure well need to present.
3,672,000.
Yao, you are interfering. Yao. I don't see why you should try.
Sorry, my hand. Sorry.
3,672,000.
Oh. $3,672,000.
Yes, please.
Right?
Yeah.
Then let's go to the option 1. The option 1, what were the details we took? Our workings we took, what were the details?
So option 1, we had 6, the selling price being 6 by.
The selling price was what? Just give us the details. We'll calculate ourselves. Selling price was what?
6 cities.
6 cities.
What was the
number of units?
900,000.
900,000.
900,000.
So times 900,000. That will give us 5.4, right?
Yes,
Yes.
sir.
We'll put it there as the revenue. I'm facing the touch, so you write it down as revenue. Write it down as revenue, 5.4 in option under option 1.
So the VC will be still the same.
Yes. They didn't tell you anything about variable cost.
Yeah, so we maintain.
No, sir.
We maintain the variable cost, 3,672,000. Let's go to option 2. Option 2, what did they tell you?
Okay, we will maintain the selling.
No. Give us the information. What did they tell you? Option 2?
Variable
So
cost.
variable cost.
4.59.
They didn't say anything about selling price and number of units.
Yes, sir.
No.
Yes,
So
sir.
maintain the revenue, 400,000. They didn't say anything about variable cost.
They said option 2.
They said
What's the variable cost?
4.9 by
4.9 by what?
by 720,000.
20,000. 3,528, right?
No, sir. It is 330.
The number of units is 7.
3564,000.
The number of units is still 7. Did they change the number of units?
No, it's still
No.
7.
No, sir.
But I thought you said the variable cost is 4.9.
4.59.
4.59.
4.59.
20,000.
So that
3,304,800.
Yes.
Please, when you are evaluating options of profitability, these are some of the issues. You need to take your time and watch the figures. 3 what?
3,04800.
3,304,800. Then option 3. What did they say about selling price and number of units?
Selling price was
Selling
decreased.
price 6.75.
6.75. Did they tag the number of units?
Yes.
Yes, sir. It was
What is the
900.
900,000.
Yes.
Yes.
6,075,000, right? Right?
Yes. 6075.
Did they say
Yes.
anything about variable cost?
No, sir. It
No.
was fixed cost.
No.
Please let me put this thing clear. Some people will be watching, so let me write it all. Yes. Option 1 revenue become 3,672,
Yes.
Yes, sir.
Charlie.
Your screen went off, so I couldn't continue with the questions again. But then he came to project the question at the side for us. So. Yes. Oh, when him a boy, what number?
Who is that? Discipline
Who is
yourself.
that?
Discipline yourself, eh?
The
Daniel
Zoom link.
Selam.
I sent
Discipline
to the
yourself
Zoom
now.
link.
Yes, let's go on. Did they tell us anything about variable cost in option 3?
No, sir.
No.
We maintain the 3672.
3672. Good. So take all that out and get the contribution. Take all that out.
Okay, so the first one, the current will be 172,800.
172.
800. 172,800.
8,000.
1,728,000.
What about the option 1?
Same for the option 2.
What about the option 1?
The option 1 is the contribution is what we get, 1,728,000.
The same thing.
Yeah, so the current, yes, that is the same for the option 1, sorry.
What about option 2?
It is 2,095,200.
2,200.
295. 200.
Yes.
What about option 3?
2,403,000.
2,403,000. Okay, so this is our contribution. Then now check the fixed cost for the current.
It will be maintained.
Oh my gracious. Fixed cost. The current is what?
972,600.
Option 1.
972,600.
Option 2, did they say anything about fixed cost?
They said
Yes.
It became what?
875,340.
Option 3, what did they say about fixed cost?
It will also be 923,970.
970.
923.
970.
It's my network there. Unless I take it to PSU. The figure again,
923,970.
So when it sum all, give me the profits.
755,400 for current.
755,400.
Yes, for current.
Yeah.
137,554.
Option 1.
755,400.
55400.
Option 2.
1,219,860.
1,219,860.
Option 3.
1,479,030.
1,479,030.
9030.
So which one is more profitable? I think option 3, eh?
Yes, sir.
So option 3 is the most profitable, right?
Yes.
Yes, sir.
Okay, so it's 6 o'clock. We'll end here. I think we've done the major questions. The rest that will be left, they are small, so we can even tackle 6 of them at a go. It means that yes, by Tuesday we should, because now let me go up and see where we've gotten to. We've done Agri, we've done Messi, we've done Merban, we've done 2030, we've done Ubube, we've done Zombie, we've done Pi PLC, we've done NIT, Free Zones, we've done it, Agro, we've done it, Build Text, we've done it. Then please, this one, the question 2 of the CDP, go and do the A part. Are you getting it? Okay.
Yes,
That
sir.
one I left you go and do it. We've done this. So we left with Sementia, that's relevant costing. Yes, Palo
And the
PLC.
multiple products.
This is limiting factor. You can try your hands on it. Palo PLC is limiting, and the multiple products of Zuma, and then the question bank. Yes, there are some questions in the question bank. Mostly they take some touches small and throw it for you. So I want us to look at that too. So the question bank questions, they are small. So I'm sure, yes, we have these limiting factors here. Tabri, yes. Okay, so I'm sure Tuesday we'll select the bigger ones in Tuesday. There are 3 relevant costing questions in it. I'll solve that one. The Sementia in December 2022. And then in the question bank, there is a question called Product B22, very long one. Product B22, it is in this. And Jan Manufacturing Limited. So I'll solve on Tuesday. I'll solve the 3 questions on relevant costing. That will take no time. Then we'll still be able to look at a few. So we'll solve the multiple product CDP, the 2 of them, and then we'll solve the multiple product CDP and the relevant costing. Then the rest in the document, I'll leave it for you to be trying your hands on it whilst we start with variance. Is that clear?
Yes,
Yep.
sir.
Yes, sir.
That's a
So variance analysis.
sorry,
Monday.
Monday.
Yes, so I
you
said,
do
remember. Yes, remember me on Monday.
okay.
I read information. So when you put information on the platform, I'll definitely read.
Okay.
Mostly every night before I start, I check all my platforms. So when you send a message, I know. So if I have not responded, don't assume I don't know. I'll respond at the right time.
Okay.
So please, the one who will take the pictures, I'm going up for you. So I take all the pictures neatly for us. Okay, let me come back with the board. So far, the decision making, so far, how far? Yes, decision making, so far, your understanding, is it improving?
Yes, please.
Okay. So if your understanding is improving, please practice. If you don't practice, you will forget all the principles. At least deleting a segment, we've seen it. Make or buy, we've seen it. Special order, we've seen it. Limiting factor, we've seen it. CVP, we've seen it. I'm sure when you see multiple product CVP and you also solve relevant costing, now you'll be fine. The rest, you can follow up that approach to solve. Is that clear?
Yes, sir.
Sorry, I think the document that we use, I couldn't catch up with the document.
You couldn't catch up with the document.
I mean the printer that we are using. I was late, so I just followed with the solution. I don't know whether.
Who is speaking? Is it Gideon?
Yeah, it is Gideon.
But Gideon, the document is on the page. I put the documents on the page for you. So you are supposed to download the document. The document is on the page.
Okay. Thank you.
All right. So we'll meet again on Tuesday. Till then, may the good Lord be with us.